the week ahead. This is one of the most confusing periods in the market that I have experienced. On one side, you've got well-known people and respected people calling for major corrections in the market. On the other side, you've got significant, knowledgeable people. For example, the chairman from Goldman Sachs, or one of the senior Goldman Sachs people the other day, saying they're fully invested. I don't think I've ever seen the market as divided as it is right now. The other thing that's going on in here is that there's almost no equity flow. When I talk to the institutional trading desk, they're talking about equity flow is just absolutely almost non-existent, but everything is focused on these zero-dated options. Now, I use the word gamma. I'm not a, I'm not a big options expert, but gamma just gives you an indication of how much, the option's going to move relative to the change in the market. And what you'll see, for example, on Friday, late Friday, you see a big spike to the upside, a big spike to the downside, and then the market closes back in the center. And I suspect that a lot of that is just because of so many zero-dated options being so very sensitive. When they're almost at the money, these zero-dated options, they will move very similar to the stock or to the future. And it's almost all very heavy speculative money. That is a very dangerous situation in the market. Clearly, we don't need the monthly, weekly, and daily charts at this point because the market's at all-time highs. The first major reference I'm looking at to see if there's any change to the downside would be a combination with the market trading below the afternoon pullback low on Friday and closing the double distribution from Thursday. So what you're looking for, if it closes that double distribution and then you start to get downward range extension, that would be an indication that there is some more serious selling taking place in the market. Now, the world is heavily focused on the change or potential change or lowering of interest rates at the FOMC meeting to be announced next Wednesday afternoon. We talked about it last week, and I want to just cover it again this week. The majority of short-term traders have automatically assumed that lower interest rates will take the market higher. Historically, what we have found that when the Fed lowers the interest rates because the market is too strong and they want to keep it from getting out of hand, the market will normally continue higher and the lowering of the interest rates will be positive. The next case, and which I think is the potential case right now, is when the Fed lowers the interest rates because we are seeing particularly declines in employment. If you look a couple of months out after that change, historically that has not been positive for the market. I don't know what's going to happen, but all I'm suggesting here is keep an open mind. Don't automatically assume what so many of the short-term traders are assuming. We have some heavy news that starts on Tuesday with retail sales, and I think retail sales can be closely watched. And of course, then you're going to have the news on Wednesday following the FOMC decision. Be very cautious as we go into next week, but let the market tell you what to do. Keep your biases aside. Thank you. Have a great trading week.